So welcome everyone. It's 2024. We're here with our first Bean Ninjas Ecom Financial Experts webinar. For the year, I've got a fancy shirt, a fancy mic, and I have with me Chad Huebsch as well from Blueprint Tax Partners. We're here to cover for you a very relevant topic as we enter 2024. It's time to adult again and time to start thinking about your business and in particular, thinking about e-commerce tax planning. So thanks, Chad, for joining us. I'll bring up some slides throughout our presentation, but I'll try to keep those slides to a bit of a minimum. Chad, I think if we kick things off here, one of the first slides that we'll share is that fancy introduction. So if you will, Chad, just share with us a bit about yourself and Blueprint Tax Partners.
Yeah, thank you, Wayne. Appreciate being invited today. So I'm the principal of Blueprint Tax Partners. I have there's 5 full-time staff, including me. We're 100% dispersed. We're all work remotely. We don't have a physical office. Started during the pandemic, and we just went full bore after that. As the name implies, we focus on taxes. We want to be that tax partner with growing businesses in the e-commerce space. I myself am originally from Arizona, and this year doing something a little bit different. Rented out my house, and my wife and 3 kids. We hit the road in the back of in our RV, the fifth wheel specifically. So I'm actually in the back of my RV right now. We're parked. Last month we were in the Keys in Florida. Right now we're right in between Tampa and Orlando. But the last 8 months we've been to like 37 states. So it's definitely not your dad's CPA experience working with us.
That's awesome. And I remember meeting Chad when I was in a search for an accountant to support myself and our businesses. And what really struck me was the family-centered nature and really the camaraderie that Chad and I were able to build. But on top of that, the unique expertise and the ability to also leverage proactive systems in collecting information. And the process was seamless for me. I felt like very well supported. I really appreciated that. So after that initial experience, I had asked Chad to partner with us in delivering tax planning and tax filing services to our Bean Ninjas customers. So we'll jump into our agenda. What we're here to cover today, folks, is how to choose the right company structure. I think most of tax is determined based on this single principle. So it's something to really consider as you're looking to launch or maximize the tax minimizations or tax strategies within your business, as each organizational setup requires its own set of tax requirements. We'll get into when to transition company structures, some e-commerce bookkeeping best practices to make tax time a little more simplified. Chad's going to share some expert tax insights and some common pitfalls to avoid, and we'll leave some time open for some submitted questions that we had. So Chad, we ready to get things rolling?
Let's do it.
I think first I'll turn it over to you to talk about company structures.
Yes. So picking a structure is very important. And there's multiple purposes here. So there's a tax focus, there's a bookkeeping focus, and there's a legal focus. I'll leave the legal talk to attorneys, but from a tax perspective, there are some specific reasons to set up an LLC, a corporation, or a partnership. And really an LLC gives you some flexibility where you can be taxed as a corporation, as a partnership under the LLC realm. Some elections that you file with the IRS there to dictate which filing to do. But if you're taking a step back, if you're starting a business and you want to be serious about it, form an entity. It provides some protections there, but also gives you some flexibility and just some legitimacy to the business. So it might sound silly to some, but for most people starting, they're just trying to sell a product. They're just trying to get money out there and collect it. But what's super important is setting up an entity, setting up a bank account under the name of that entity, and not commingling personal and business funds. That's like the number one way to kind of just go down the wrong path of keeping business and personal finances separate. But circling back to the entity choices, so you can operate as a sole proprietor, which is just basically yourself. You open up a bank account in your name and keep it separate from your personal expenses, but set it up that way. There's an LLC, there's corporation, and if you have multiple owners, you can set up a partnership. And like I said at the beginning of this, with an LLC, you can elect to have the LLC taxed as a corporation, which is a corporation in its truest sense, and sometimes it's referred to as a C corp. There's also an election to be taxed as a small corporation or an S corp. And then, of course, if you have an LLC with multiple members, the default is to be taxed as a partnership, and there's different ramifications for each.
And when's the right time to set these up? I know a lot of folks are really concerned with product market fit and being bootstrapped. A lot of brand operators don't want to invest considerable amount of money into something that they don't see value in. But what's your recommendation on when the best time to designate this company structure is? And then where are some good resources on how to learn a little bit more or how to actually get that LLC established?
Yeah, so some people get LLC happy and they just start forming up LLCs. And there's actually some new reporting that we'll get into as part of this conversation, that there's a good reason to not just set up LLCs willy-nilly. But if once you have a concept and a product, I would say there's really no reason to wait setting up, in this case, an LLC. It's usually not that expensive. You're probably looking at a couple $100 to set it up. Some states like Arizona, there's no ongoing annual filing fee. So you set it up once and then you're good. Other states, there's an annual filing requirement and a state administration fee. So you're looking at a couple $100 with an LLC. And really, if you start thinking about insurance and some liability protection, plus the tax, creativeness that we can layer in there, in my opinion, once you kind of get the ball rolling the first month or so and you start actually making sales, there's really no reason to wait setting up something like
Yeah,
that.
I think once it moves beyond an idea and from a side hustle, it makes a lot of sense. You consider some of the most successful DTC brands is they're well established and they own their branding, their name, a lot of the rights, a lot of these legal situations also help carry a lot of weight if you're an established LLC. So I think there's a lot of things to consider outside of just the financial tax implications when looking at this. So when you're serious, look to invest that little bit of money, as Chad shared, to get that ball rolling.
It goes a long way. For sure. And it creates this legitimacy. And sometimes founders have like a little case of imposter syndrome. But if you have this LLC or the corporation set up, it helps like create that persona that this is a legit business, and you'll grow it and treat it as a legit business as well.
Yeah, it's interesting too. You mentioned the word growth because I was thinking the same thing. I think one of the common roadblocks that e-commerce brands run into is access to capital. Well, if you can get that LLC established and start collecting those sales through the LLC and get into a position where you then can show a potential lender runway within an organized structure, and it's not, hey, let me pull my personal financial statements together and then I'll designate, yeah, that was a deposit for sales that came through. That legitimacy and that opportunity to show someone organized, structured financials help support those requests for lending as well.
Yes, and I think you referred to at the beginning of this as adulting. Like let's be adults and let's get serious. It just adds like that, credit as like, hey, we're really making a go at this, with potential investors, with banks when it comes to financing and otherwise. So
yeah, absolutely. So one of the questions we often ask is, hey, I did that. I stepped up. I formed the LLC. I have a very basic LLC registered and structured. When's the right time to consider shifting or changing my structure? And you also start to get bombarded by advertisements and you see the tax influencers that are like, you need an S corp. You need to designate, if you're an LLC owner, you need to be an S corp. Is that the case for everybody?
it isn't. So it's a little bit of not one size fits all. There's some customizability there. So with an LLC in place, it's really looked through. It's not regarded for tax purposes. If you just have a LLC with one owner, So you're treated for tax purposes as if the LLC doesn't exist, which you're going to get taxed a couple different ways that way. So income tax, federal and state. Federal all the way up to 37% if you're making some good money. State, depending on where you're at, there's a little bit of a dichotomy in Arizona where it's a flat 2.5%. In California, just I think raised theirs again up to 14%. So very much a big consideration there. But I think the biggest thing to think about as well is self-employment tax. As an employee, it's automatically withheld from your pay stub, but once you're self-employed, you're hit. It's a flat 15% on about 166,000 of profit, and then after that, it's about 3% above and beyond that. So with just an LLC, you're going to get hit on all of those taxes there. With the S corp, the biggest reason is to modulate and dictate essentially how much of your profit is subject to that self-employment tax. So it's a great self-employment tax saving strategy. And really that's the biggest reason to convert to an S corp, is so that, and it'll be an LLC for state purposes, but for tax purposes, we can elect it to be taxed as an S corp. The way to save on the self-employment tax, again, that 15%, is you put yourself on payroll. So, and whatever wages you pay, it's going to be subject to that self-employment tax. Everything else, all the other profit, any other distributions that you take out of the business, still subject to income tax, but it's not going to be subject to the self-employment tax. One thing to keep in mind with that is that the savings are about $10,000 for every $10,000 worth of profit. It's about $1,500 in tax. So it can quickly add up and be a $10,000 to $20,000 tax savings a year strategy once you start making a profit.
And is there a magic number that is to help advise people when to significantly consider that switch?
That's a good question. There isn't. You'll probably see stuff across the board. I've seen some professionals say if you have $30,000 in profit, others go up and say if you have $100,000 in profit. Just remember, at that $100,000, that's almost $15,000 worth of self-employment tax is that you're costing yourself there. What I recommend keeping in mind is there's two extra things that you have to do once you're an S corp. One is you have to put yourself on payroll, so you actually have to adult and get ADP, Gusto, some of these other systems out there, pay for payroll. If you're the only one on payroll, with Gusto, you're probably paying $600-700 a year. But again, factor that in with the tax savings. The other large cost to converting to an S corp from just an LLC is the extra tax return. At that point, you have another tax return, which can range anywhere from $1,500 to $3,000 or even more, depending on who you go with. So for me, it's about $50,000 worth of profit. After factoring in the additional costs of payroll and a separate tax return, you're still coming out ahead at that point.
Yeah, one thing you mentioned brought to my mind an interesting question as well. As you mentioned, the different tax rates across a number of different states. So as an entrepreneur, do you have the ability to decide what state you register your LLC in?
That is a great question. And there's a good answer for that too. A lot of people sometimes get an idea, sometimes from social media influencers, that, hey, let's set it up in a no tax state like Wyoming or Nevada. But let's say you're based out of California. Just because your LLC is registered in Nevada, but you're basing all of your operations out of California, you're not rinsing yourself of any California tax liability. Wherever there's wherever your entity is formed, wherever you have people, i.e. owners or employees, and owned inventory, that's where it starts creating nexus. So where your states are going to be able to tax you. So in some cases, people say, I have a Nevada LLC, I'm not going to get taxed on that income in California per se. You're going to get taxed on wherever you're running your business. So generally, it's favorable to set up an LLC in the state that you reside, where you're running your business. There are some other legal reasons to set up like a Wyoming or a Delaware or Nevada LLC, but you're not kind of wave the magic wand and get out of tax because you're setting it up in one of those states.
That makes a lot of sense and clears up a bit of confusion. So I want to jump now into e-commerce bookkeeping best practices when considering tax planning, tax filing services. So I think here I'll take some of this. I really think of this in three major areas regarding best practices. First is your organization and planning. I think tax is both, uh, unfortunately for many, a reactive experience that doesn't need
Mhm.
to be one. It very much can be a proactive exercise. And I know, Chad, you do a lot of work with brands in tax planning and proactive strategies so that at the end of the year, much like Christmas, your tax bill is not a surprise. It's going to happen every year. So
Yeah.
there's certain steps you can take in ways in which you can understand what that burden would be. So I really look at first organization and planning. Then, as I'm beginning to consider at the beginning of the year, pulling things together, their accuracy and review. And then lastly, communication and collaboration. So, kind of touch on organization and planning first. Really, what this means to me is start gathering your documents early. It shouldn't be a surprise as you continue to operate a business what types of things will be requested of you by your tax accountant. You want to begin and throughout the year consider receipts for major purchases. Anything that you're thinking about writing off or establishing as an asset, you want to collect and store those receipts in a file so that you can easily refer back to them at tax time. Any significant invoices, bank statements, tax forms that you may have received through the year, instead of scrambling at the last minute, simply have a place in your personal filing system on your laptop that you can begin to create that folder. So at tax time, when those requests come through and the portals are open to start exchanging information with your tax professional, it's as easy as granting them access to those folder. Just a quick little click and drag over to that folder that gets the ball rolling. Also, start scheduling in as you're getting meetings this year. Start putting a placeholder for next year around the same time to start considering, hey, I need to make that call to my tax accountant, or I need to chase down this particular supporting document. Create a timeline for those year end bookkeeping tasks like reconciliations and inventory stock counts and looking at your asset register to start looking at your depreciation schedules. These types of activities will just help you stay on track and avoid procrastination. And I alluded to it too, start utilizing technology. There's now apps that support many of these things. Invest in accounting software, particularly cloud based bookkeeping solutions that help streamline your record keeping and help automate tasks like backups and those reconciliations. Also, a plug, reach out to an e-com specialist bookkeeping firm like B Ninjas to provide that support so that we're on top of things, so that you're not looking to invest so heavily in that year-end reconciliation and catch-up, cleanup bookkeeping activity at the end of the year when so many folks are looking to get those returns submitted to their accountants. Chad, any ideas here? Any thoughts on this first phase around organization and planning?
Yeah, I think again, it's part of just like legitimizing the fact that you're running a business and treating it as a business, not as a side hustle, not as a hobby. Of like really going in. Cloud bookkeeping software should be ubiquitous now. Everyone can have access to it, whether it be QuickBooks, Zero, or any of the other numerous variants. But those are the two big players. And really, you talked about scheduling out and scheduling in. There's really kind of an old school mentality of I'm not going to talk to my CPA until tax time, mostly because maybe he's going to bill me, or maybe like she's unavailable over the summer or the rest of the year, right? But for our clients that we work with, we love working with B Ninjas because the books are up to date. You have numbers to go over with B Ninjas. You can look at ratios. You can see where you're benchmarked in the industry. And then where we come in is on the tax side is filing tax return should be an afterthought because we've met throughout the year, every quarter or twice a year, reviewed your numbers, let you know what your estimates should be, and talked about strategies during the year so that when come tax time, it's like, oh yeah, even before tax time, rolling into the holidays, we know what we're going to owe. It's not going to be this crazy number that we're just hoping that's not going to be huge and potentially put us out of business or have to draw on a line of credit or put on a credit card or something. So you can be proactive.
Yeah, we both probably have seen that experience, right? Where all the social media influencers are telling you, get maximize your deductions by purchasing these new vehicles at the end of the year, buy heavy equipment. And then the tax return comes around and the entrepreneur identifies this tax liability that they have to now source funds to pay. So it's one of those things, it's in being proactive. Some of those strategies certainly make sense, but you want to consider the full picture and where your potential liability might be and what that minimal savings on these large ticket purchases might look like. I want to jump next to accuracy and review. These are year-end tasks that can be done each and every month, but really a focus on end of financial year prep for tax planning is critical. Oftentimes, entrepreneurs put their books together for more of a financial operations lens. And of course, throughout the year, you want to be in that position where you see your business maximizing profitability, right? And you want to do and make those decisions that allow for your business to have the highest profitability and cash flow. But when it comes to tax time, there's a little bit different lens, right? You want to show the least amount of profit so that that profit is then taxed at at a lower rate, and that tax bill is minimized. So, in looking at your books from a tax position, some of the activities that you want to do from a bookkeeping perspective is ensuring that you've reconciled all your bank accounts. You want to make sure that if you're using cloud accounting software, there's no unreconciled bank transactions. You want to take the actual download of your bank statement from your bank and ensure at a minimum the ending balance matches what's in your accounting software. In the accounting world, we call these balance sheet reviews because these bank account balances are listed as assets on your balance sheet. There's a lot of sexy talk about enhancing your P&L and focusing on driving the key margins in your business. But this discipline to really looking into your balance sheet, ensuring those clearing accounts across the multiple payment gateways from Shopify, Afterpay, Klarna, QuadPay are all being reconciled and matching the source of truth, which are those sales channels and payment gateway statements. So you want to do that for all your bank accounts, your credit cards, your payment gateways. You want to resolve any discrepancies and make sure that line by line, all the records have been processed and entered into your bookkeeping software. You also want to look at any outstanding accounts receivables. So invoices that you've sent to potential, let's say, wholesale vendors that haven't been collected. You want to write off or chase down anything that might be deemed uncollectible. You want to also look at your accounts payable. Do you have any outstanding bills that you haven't paid that, particularly in doing something like this in mid-December, maybe you have the opportunity to make those payments, prepay some of these invoices so that depending on how you're filing your taxes, you might put yourself in a more advantageous cash position. You want to look at your physical inventory counts, take a stock take. What's critical in e-commerce tax planning is understanding how much inventory you have on the books. Just like the balance in your bank account, the cash, inventory is another asset that needs to be reconciled and managed. So get a true count, reflect on the major differences from prior years, and also really reflect on the valuation. Is there inventory that can be disposed of? Is there any wastage? Has there been any theft? Has inventory been lost in the warehousing? These things will be questions your tax accountant will ask. Check your fixed asset register if you purchased big equipment or even things like computers for your team members. Make sure you're aware of the useful life and also those big purchases that you made through the year. Your tax accountant can do things and structure these assets in a way that might be able to accelerate some tax savings throughout the year. And then lastly, review your prior year adjustments. You're a good tax accountant and one that you're in constant communication with should be providing you adjusted journal entries from the previous year. So you want to make sure that you or your bookkeeper actually recorded those in your bookkeeping software. Because I can imagine, Chad, one of the first things is that's done is looking at the balance sheet and making sure the starting point matches what was reflected on the tax return for the previous year. So any tips or tricks around accuracy and review that you can share?
Yeah, I think a big thing that you should look at, like you said, any big purchases, keeping those invoices. Um, if you have any liabilities, credit card, line of credit, bank loans, those payments you're making against the principal that's reducing the balance, those are not deductible. Those don't show up on your P&L, but the interest is. So it's very important that you're breaking out the interest and principal component. One of the first things we do when we look at a tax return and for prep is we'll see if the balance sheet matches the prior year. So what we do for our clients that we have access to their books, let's say in QuickBooks, we'll actually lock their financials after we file the tax return, just so there's no inadvertent changes. But we also ask for end of year bank statements, loan statements.
Yeah.
We're not doing the bookkeeping, but to your point, we want to make sure that if there's $100,000 on QuickBooks at the end of the year, that there's $100,000 in your bank account, and all the loans are tied out as well. So P&L is, like you said, gets all the attention, but if you have a clean balance sheet, that's what investors and people looking at your books to buy you out, that's what they're really going to be looking at, is your balance sheet, making sure there's nothing there that shouldn't be.
Yeah, awesome. And one area that I know you guys do particularly well is around communication and collaboration. So I'll just share two things to consider here is really collaborate with your bookkeeper or accountant, share those organized documents that you pull together, your bookkeeping progress throughout the year. But also like continue to maintain that monthly rhythm of reconciliations, monthly bank account closeout in reconciliations, ensuring that there's not a high volume of unreconciled transactions that remain in the books. Not only does this type of communication help provide you the most timely, accurate, and insightful view of your business so that you as an entrepreneur can make those key decisions to adjust and course correct any issues that might be visible within these numbers, but it also really helps at tax time avoid that crunch and that rush that comes about in trying to get these tax support documents pulled together. And then also, not just as much with your bookkeeper accountant, communicate with your tax accountant if there's particular life events that have occurred that might impact not as much your business tax return, but your personal returns. Make sure you're bringing these things up. And then lastly, communicate with your clients and vendors too. You want to make sure that any outstanding invoices or receipts are being proactively followed up on so that you have all the financial data and materials available at your disposal. Think of things like W-9 forms from any suppliers. Think of your requirements around those 1099 submissions. Think about your employees and issuing on a timely basis those W-2s. Just be more proactive and really get in front of these communications. But Chad, I do want you to share too a little bit about the proactive conversations that can be had each quarter end, more in consideration with your tax liability or your tax position.
Exactly. And this kind of goes back to the entity structure as well. The only entity, a corporation, specifically a C Corp, so not S Corp, the only corporations will pay tax on their own. Like none of that income outside of the wages or the dividends that you take out shows up on your personal return. So that's separate. S Corp, partnership, LLC with no tax election, whatever's in the business bank account at the end of the year, you're going to get taxed on as well. So regardless of how much you actually take out of the business, those are called pass-through or flow-through entities. All of the activity is going to flow through on your personal return. So when we look at meeting quarterly, we're going to review those numbers with you, look at any other income sources. If you have a rental property, if you have a significant other that works, if you've got passive investments that are generating interest and dividends, we want to look at the whole picture so that we're not just focusing on one piece and kind of missing the forest through the trees. So review your numbers, which gets back to your point of having accurate numbers, doing that monthly reconciliation. There's nothing probably more frustrating for a client to come to a meeting with their tax accountant to review the numbers, and then I look at the books and see nothing's been done, or we're way behind and nothing's been reconciled. So once we do that, we can have proactive conversations. And instead of saying at the end of the year, you owe $50,000, it's every quarter you're going to pay in, 12,500. But as part of that conversation is we are going to ask you, okay, how do you think things are going in your business? This is what we see on the numbers. You tell me you're running it the day to day. And what's happening? What's coming down the road that's going to change? Oh yeah, Chad, we're going to book a whole bunch of more inventory at the end of the year because things are really ramping up. Well, that's going to change the numbers where we wouldn't know that unless we have these conversations with you.
Absolutely. So you started to introduce kind of a great intro to our next topic. So now I'd like for you to really cover how to avoid some of the most common tax pitfalls.
Yeah. So one is just kind of putting your head in the sand and not being cognizant of what's coming. Nobody likes taxes except for me. I'm the nerd that loves taxes. Nobody likes, and understandably so. But it's one of the things you have to respect, and to respect, you have to know what's happening. So every quarter, the IRS wants you to pay in a quarter of what you think you'll owe by the end of the year. So that's important. If you're not paying in anything, but you're generating profit, know that the tax bill will come due. On the flip side, after the fact, everyone needs to file by April 15th. That's when tax day is. You can file for a 6-month extension. Some folks believe that filing for extension is an increased audit risk. It isn't. There's multiple reasons to file for a 6-month extension. But one misnomer about filing for extension is that it gives you six more months, or until October 15th, to actually file your tax return. It does not extend the deadline to pay. So it's kind of a gotcha. The IRS says, yeah, sure, we'll give you 6 more months, but we want you to pay in what you think you're going to owe regardless by April 15th, which is a gotcha in some cases. And it hasn't really hurt too much in years past because the interest rate on underpayments have kind of followed interest rates. But as you've seen the last year, 2 years, interest rates have crept up. So in addition to owing the tax, you could owe 8% on the tax plus the penalties for not paying on time. So it can really add up. So don't think that you're delaying the tax bill by filing an extension. You're just delaying the filing the return. IRS still wants you to pay what you do. So that's one common thing that I see.
It's been interesting this year. I'm seeing more news, particularly for parents, that it might be a good time to file for extension based on some changes that may be occurring within the tax code. Do you have any insights to whether or not that's another kind of Instagram learning or is based in some reality?
There is a bill in Congress. It's passed out of the House committee, a Ways and Means committee, but it hasn't actually passed and it hasn't gone in front of the president yet for signature. But there are provisions in there that would be retroactive back to the beginning of 2023. Some of the big things business owners, e-commerce brands should know is that it brings back 100% bonus depreciation. So any asset that you buy that's over 2,500, the IRS makes you capitalize and depreciate or deduct over a certain number of years. Sometimes it's 5, sometimes it's 7. For a building, it could be 39 years. So what bonus does is allows you to take whatever that is and depreciate it all this year. Right now on the books is it's 80% instead of 100. For 2024, it's scheduled to be 60, 2025, 40%, all the way ramping down. But the bill in Congress is going to retroactively change that back to 100% for 2023 and extend it through 2025. So again, it's not law yet, but that's super favorable to businesses. It's bringing back some potential R&D benefits that starting in 2022, we had to delay out kind of like depreciation where you can't get the full deduction this year. You have to spread it out over 5 years. So there's a change and a fix to that. Plus, if you have a lot of interest expense in some years recently, we've been limited to how much you could claim. Now they're going to kind of offset some of those limitations. Plus, there's talk of expansion of the child tax credit as well. So if you have any kids, it could be some additional benefits. But again, it's kind of wait and see. Those are just some of the things that we've heard are in the potential bill.
Yeah, but to remind folks of your top tip, that does not mean you have 6 more months or that extension period to make what you believe is your final year-end tax obligation.
Exactly. So again, it goes back to maintaining clean books, and having proactive conversations with your tax pro is so that you know what's coming down the pike. One of the other big things that we're seeing that has never existed before, but it's new for 2024, is the FinCEN BOI, or beneficial ownership information reporting for all new entities. Have you heard about this?
Yeah, I'm aware because often the conversation has been who really is responsible, and is this something that bookkeepers and accountants should take on their shoulders, or is it really a function and task that each entrepreneur needs to be more informed about and responsible for?
Good question. So the reporting is basically any entity that required a state filing. So an LLC, a corporation, in some cases even partnerships. They the and this passed in the Corporate Transparency Act back in 2021, and it kept getting delayed being implemented. But this year it is implemented. So any existing LLCs or corporations that existed prior to 2024, you have until the end of this year to file your initial report, which basically says, I own a business. This is where it's located. This is its EIN. Here are the owners. This is where they live. A lot of information that you would see on your tax return, but there's a new reporting requirement. It's not public information, so it's only going to be available to certain government agencies. The thought being that it's going to help combat some financial crimes, money laundering, etc. Each state can dictate whether it's something that attorneys have to do. I haven't heard any state who has come out proactively and said you have to have an attorney prepare this report in our state. FinCEN, which is the sub-department under the Department of Treasury who's in charge of administering this program, in their FAQs, they say, talk to a lawyer or your accountant on how to file this. So we have to file it. You can't get around it. There's penalties for not filing it. It's for willful disregard to the rules. So we can't put our head in the sand and say we didn't know about it. You should ask your accountants, and if you have an attorney, ask them about it, what the plan is to get you filed and up to date for it. And again, willful disregard for the rules it's $500 a day up to $10,000 per entity. So they could quickly add up if you just kind of push it off and say, I'm not gonna file this report.
Yeah, remain
Yeah.
ignorant.
Exactly. So any new entities, we have 90 days. So if you form a new LLC or a corporation in 2024, we have 90 days to file that report. And then if there's no changes to the owners or the entity address or otherwise, there's no additional filing requirements unless there's a change to an address, or if you brought on an owner, or if you sold. At that point, you have 30 days to update the report. So again, there's not a huge value add to the business community. It's more of a compliance issue, but it's everyone who owns an LLC should be aware of.
Yeah, I think you've continued to say we, and I think what you're referring to is the entrepreneur. So you as the
Yep.
business owner or the principal, managing director, someone within the LLC structure needs to be aware of this reporting and take responsibility for the filing. I think accountants, tax preparers certainly need to be informed of what the requirements are, advise their customers that this is something they should be aware of and take responsibility for. But my understanding is it is not the accountant's responsibility to file for all their customers, much in the same way that I, as an entrepreneur, count on my tax accountant to file my taxes. This is not something that your tax accountant will just do automatically for your business. So you want to ensure that this is being done and also be responsible for that submission as well. If it is not something that your tax accountant will be offering.
For sure. Some accountants are saying, yes, I'm offering this as part of my service to my client. Just be aware, no one's doing it for free. It's going to be an additional cost because it's a whole new filing requirement that hasn't existed before. Some accountants are opting out and saying, nope, I want a third party. So they're like LegalZoom, there are third parties out there that are just going to be offering this service. Some attorneys will be offering it as well. It really just depends on, talk to an accountant and look at the reporting. It's not rocket science to fill out this form, but it just needs to be to get it filed, whether it be the owner, whether you're using a third-party service, or even just your accountant to file that report.
Yeah, I think considering the last common pitfall that I see entrepreneurs, and particularly within e-commerce operating in, is we advise for month-to-month review and for financial operations that brands capture their books on an accrual basis of accounting. And often one thing I believe is assumed that they're then required to submit their taxes in the same manner in which they're viewing their books on a monthly basis. Where is your stance in basic guidance around when for e-com brands may be the best time for tax reporting purposes to designate between cash or the accrual basis?
Yeah, so I think the IRS has some bright line tests. So it's about $30 million in revenue. So if you make more than that, you have no option. You have to file as accrual. I think most e-commerce brands, once they start getting to a certain point, like you said, accrual reporting makes more financial sense for the life cycle of an e-commerce brand. But for underneath that threshold, in a lot of cases, even though you're keeping your financials under accrual, it still makes sense to keep track of it for tax purposes under cash. And it's important to talk to your bookkeeper or your third party, like Bean Ninjas, say, yes, for financial purposes and operations, we want to keep it on accrual, but let's also kind of simultaneously know what we need to do to convert it back to cash for tax purposes. Because for cash purposes, you spend $1, that's going to reduce your net profit. Whereas accrual, potentially not, depending on when the money hits and, otherwise.
Yeah, and the service has been provided. Yeah.
Exactly. So we have a lot of clients that we do the back to cash from accrual adjustments for tax time, and it usually comes out is super favorable because we're able to deduct all of the cash payments that you've made, even just before year end.
That becomes particularly insightful in regards to spend for inventory. I mean, you have many times under the accrual basis. What makes it advantageous for brands is you have that alignment of sales and the expense and prepayments that have been made to acquire that inventory. But in the case of some brands where, in particular, maybe the first quarter is your major sprint in sales season, so seasonally you're doing better in those months, but that spend on inventory may have occurred in November, December. Under the accrual, you don't have that same opportunity to write off or match those expenses against any sales or potential tax that may be left on the books through profits.
Exactly. So there's a timing difference there. And again, accrual, if you don't have your big sales season till the spring, you can't write off the inventory in the spring. Whereas if it's cash, there's some maneuvers that we can take to deduct it when you buy it, even if you buy it on credit. And the cash actually hasn't left, but you've actually created the obligation to pay for it. And it also can lead to conversations around potentially changing your fiscal year end from a calendar year end. So if you have a very large Q1 and it makes sense to close the books in May or April, it makes sense to have that conversation with your accountant, because in most cases it's not prohibitive to change the goalposts that way.
Awesome. So I want to shift now to some Q&A. We did have some questions that were provided previously, and we will make sure that both the slide deck and the presentation are made available to folks after the recording. So you ready, Chad, to jump into some Q&A?
Let's do it.
Awesome. So the first question that I see here is, what are often overlooked tax deductions that more e-commerce businesses should know about?
Question. So the overarching thing you should keep in mind when it comes to deductions is that you're spending $1, but you're only getting a fraction of it as an actual deduction. It's not reducing your taxes dollar for dollar. So if you're, let's say, in Arizona, even if you are in the top tax bracket for federal and state, each dollar you spend, you're only saving about 39 cents on the dollar. So you're still out the 40 cents. So keep in mind with the deduction, if you need it, pay for it. If you don't need it, it's usually not going to be beneficial just to buy something to reduce your taxes. Some things that get potentially overlooked are, and also could be hot button items, is travel, meals, paying your kids. Those are all things that can be legitimate deductions, but you got to do it in the right way. So for meals, sometimes there can be like, hey, I'm working, I need to pay for this meal, and I'm going to write all my meals off. Be judicious. The rules are you having a conversation with either immediately before, during, or after the meal with a employee, a vendor, a potential vendor, a customer, potential client, etc. Don't do the extravagant meals unless there's it calls for it. And on another topic is travel. If you're traveling to a vendor or an event or a conference, all of that can be deductible, which includes airfare, hotel, meals while you're traveling out and about. And really, travel is anything outside of your city. So if you wanted to put a number to it, you could say 50 miles outside your city. Basically, that doesn't allow you to come back home at night.
Mm-hmm.
Could be considered travel, and those expenses would be deductible. One big deduction that is not highly advertised, but is basically almost free, is the qualified business income deduction, the QBI deduction, also known as the 199A deduction. If you're an S Corp or a sole prop or a partnership, any of the net profit from the business, you can get basically a 20% haircut or 20% deduction on all of that flow through business income up to a certain dollar amount. So if you're married and you make more than 400,000, or if you're single and you make more than 200,000, that straight 20% starts getting cut back, and it actually becomes a function of your overall wages that you pay in the business. So one thing we do with our clients is we analyze that deduction throughout the year, look at the projection of the numbers, and we, in some cases, actually recommend clients bonus themselves out so they can get bigger qualified business income deductions at the end of the year.
Awesome. So the next question, you've mentioned a few dates throughout the presentation: March 15th, April 15th, October 15th. What are some of the key tax filing deadlines and requirements specific to e-com brands?
Yes. So we're actually, 7 days from a big deadline. So if you've paid a vendor or really anyone third party for services more than $600 for last year, which can be inclusive of a lot of people, including accountants and bookkeepers, you have a 1099 reporting requirement. So by January 31st of 2024, everyone that you've paid more than $600 to for services, you're outside of employees, you have to issue a 1099 for. So what you should do before you actually submit that bill for payment is get a W-9 from them, which basically has their name, social, or their EIN and their address. Get that from them as part of requiring that payment. So that one's coming up. March 15th is a deadline for any pass-through entity income tax returns. So partnership, S Corps, those are due by March 15th. C corporations and individuals have due dates of April 15th. One thing to keep in mind, April 15th is also the due date for your first quarter estimated tax payments. So if you haven't planned ahead, it can certainly be whipsawed by not only owing taxes for 2023, but the IRS does want their first installment of your estimated taxes for 2024, and that's April 15th. So it can come around and rear its ugly head for some folks.
Absolutely. So what are some tax considerations when determining when to draw a salary against taking dividends from your e-com business?
Good question. So if you're organized as an S corporation or a C corporation, the IRS wants you to take a reasonable salary. And they haven't given a bright line test of X percentage of profits or really any straight guidance. They've given you, I think there's 13 tests that they say measure it on, but basically what you would pay a third party to perform the same level of services, that's the salary that you should take in an S Corp. Because really the tax savings there is the lower salary you take, the more payroll tax savings there's going to be. But the IRS buffers that by saying you at least have to take a reasonable amount there. with an S corp, you can take money out as distributions throughout the year without like a tax impact of actually taking the money out. With a C corp, dividends, any dividends that you take out of a C corp, that's going to be subject to a 1099 reporting for dividends, and you're going to have to report that as the taxable income on your personal taxes at the end of the year as well. So with anything, taking money out of the business, budget for it, monitor it, see how things are going throughout the year. And I always say, and it might be a little bit of the conservative, prudent accountant in me, but take less out earlier in the year and wait and kind of, it's a delayed gratification, but take that bigger bonus or that distribution out at the end of the year when your cash flow is met.
Awesome. We're running short on time. I'll scan through to see. This is an interesting one. How do you handle tax reporting, or is there any difference in handling tax reporting when selling both physical as well as digital products?
Good question. So there's just the money trail piece of it. So you're going to be tracking that whether it's a physical or digital product. But I think the biggest thing is going to be potentially some sales tax implications. So sales tax on that can vary depending on the state, and each state has their own rules. So most states will tax the physical product, and states have now gotten wise to digital assets and digital products. So in most cases, they tax it as well, but sometimes at a different tax rate. And some states don't tax them at all. So it's important, especially if you're potentially doing some software sales, it's definitely important to work with a third party like Avalara or else to make sure that you're taxing it appropriately.
Yeah, we also recommend our partners. Tax Valet is a great resource.
That's another good
And
one.
also Zamp is another resource. I think what we're finding now is sales tax has become so complicated that there are now firms that specialize exclusively in understanding and delivering these tax strategy, sales tax filing services. So if there's a need, consider researching those firms. Another in particular that's interesting to me, I'd love to hear your thoughts on, are there particular implications of international sales on your business's tax obligations?
Definitely, and it adds. If you think taxes are complicated within the realm of taxes, international taxes can be just a whole nother area that a lot of accountants won't even touch. So if you're, and it can depend on whether it's outbound or inbound. So you're a U.S. company making sales internationally, or you're an international company making sales into the U.S. There's different reporting requirements, and disclosures and otherwise. So it's very important that once you start making a substantial amount of sales or a significant amount of sales outside of the U.S., if you're a U.S. company, to loop your accountant in, because if you start having like foreign bank accounts, there's some additional reporting. If you have enough sales and a nexus to like Canada or in Europe or in Asia, you could have income tax filing requirements in those countries as well. So it can quickly become a spider's web, and want to stay on top of it, not get caught in it.
Absolutely. Well, Chad, we've been able to cover a lot of ground today. We were able to discuss company structures. We were able to discuss key tax filing, tax requirements, some e-commerce, bookkeeping, best practices, common pitfalls when it comes to tax planning, tax filing. Thank you so much for your time in sharing with us today. Any parting words that you want to share, or how can we best get in touch with you and the team?
Yeah, so my website's bluetaxplan.com. You can email our main email is info@bluetaxplan.com. Reach out if you have questions. We work with a lot of growing e-commerce brands and other businesses, people invested in real estate as well. Don't be afraid of taxes. Like, put it in its spot and work with a professional who you can rely on and outsource that headache to. And yeah, be responsible, get your books in order, establish that relationship with the accountant, because they're going to provide you way more value than you'll ever have to pay them for.
Yeah, adult up on tax.
Yep, that's a good summary.
Awesome. Well, thanks again, Chad. Take care.
Thanks.